Think you need a huge down payment to buy a home, or that your credit has to be perfect? You're not alone. Most first home buyers have the same worries, but the reality might surprise you.
Hey, we're Melanie and Kat, realtors with the 𝗪𝗔𝗃𝗃 Group. We specialize in helping people buy and sell homes, and we know that buying your first home can feel overwhelming. That's why we're here to break it all down and make the process simple.
In this video, we're going to walk through exactly what it takes to buy your first home, how much money you actually need, what it takes to get approved for a mortgage, and how long the whole process takes. By the end, you'll have a clear roadmap to home ownership. Let's get started. The first big question on most first-time homebuyers' minds is, how much money do I really need to buy a house? A lot of people assume they need to save up tens of thousands of dollars before they can even think about home ownership, but that's not necessarily true. In fact, you might be able to buy a home with way less money up front than you think. Let's break down exactly what you need and why waiting to buy might actually cost you more in the long run. There's a common myth that you need a huge down payment of 20% to buy a home, but that's just not true. Depending on the type of loan you use, you may need much less than you expect. When it comes to conventional loans, you need as little as 3% down if you're a first-time homebuyer with good credit. An FHA loan, which is a government-backed loan, you need just 3.5% down. It's great for buyers with lower credit scores. When it comes to VA and USDA loans, you actually don't need any down payment. It's 0% down, and it's eligible for veterans, active military, or if you're somebody looking in rural areas. There's also multiple down payment assistant options, programs from the government or from certain mortgage lenders that help cover your down payment and closing costs either through a grant or a secondary lien. But just because you can put less down, does that really mean you should? Let's talk about the pros and cons of using down payment assistance. If saving for a down payment is the biggest thing holding you back, a down payment assistance program could be a great solution. But like anything in real estate, there are both advantages and trade-offs. Here's what to consider. Here's some benefits. You can buy a home sooner instead of waiting until you've saved a 3 to 5% down payment. You start building equity now, rather than paying rent. Some programs offer grants or forgivable loans, meaning you may never have to pay them back, so basically free money. Now, here's some things to keep in mind. Some programs have income limits because apparently there is such a thing as making too much money. There are various credit score requirements. And also, a few down payment assistance programs may come with slightly higher interest rates, kind of like paying extra for guac, but way less delicious. And finally, certain programs may place a secondary lien on the home and require a full or partial repayment if you sell your home within the next few years. So if you're thinking about using down payment assistance, it's important to weigh these factors and decide if it's the right fit for you. Something else to keep in mind is there are a lot of different types of down payment assistance programs out there. Some are grants, some are loans, and others are forgivable after you've owned the home for a certain amount of years. The best option for this depends on your income, location, and loan type. If you want to learn more about which programs you qualify for and which ones make the most sense for your situation, reach out to us. We can help you navigate your options and find you the best fit. All right, so we've talked about down payments, but that's not the only cost you need to plan for. Most first-time homebuyers know they need a down payment, but many don't know about closing costs. Closing costs typically range from 2 to 4% of the home's purchase price and cover things like lender fees, title insurance, and money set aside in escrow for property taxes and homeowners insurance. The exact amount varies based on your loan type and location. These costs would be due at closing. Now, in some cases, sellers can cover some or even all of your closing costs, but that depends on how competitive the area and price point you're looking in is. If homes are flying off the shelves with multiple offers, sellers aren't as likely to negotiate on things like this. But if it's not very competitive, or you find a home that's been sitting on the market, we might be able to negotiate that the seller pays for your closing costs. So we've already covered the two bigger costs you need to plan for, your down payment payment and closing costs. Both of these costs wouldn't be due until closing. But there are two smaller costs that come up earlier that you'll want to be prepared for. Let's talk about home inspections and your earnest money deposit. A home inspection is one of the best ways to make sure you're making a good investment. It helps identify any major issues with the home before you finalize the purchase. The standard whole home inspection covers the home structure, roof, plumbing, electrical, HVAC, and general safety concerns. But depending on the property, you might want to add additional inspections, such as termite or pest inspection. This checks for active infestations or past damage. Radon test, that measures radon levels, which can be a health concern for homes with basements. If there's any major trees or it's an older home, a lot of times you may want to get a sewer line inspection. This helps detect any major sewer line issues. Something you might also want to consider is getting a mold inspection done. That looks for moisture issues that could cause mold growth. The other inspection you may want to get done is having a structural engineer come out. That's a structural engineer inspection that evaluates foundation and structural integrity if there are concerns. Many buyers start with a standard whole home inspection, which typically costs between $350 and $450. But if you opt for additional inspections, know that that cost will increase. Expect each additional inspection to cost between $100 and $200 extra. Our buyers who have multiple inspections done can expect to pay a total of $550 to $1,000. This cost is due at the time of the inspection as it's a service provided, and we always recommend our buyers have inspections. They are crucial in avoiding costly surprises down the road. Another cost to plan for before closing is your earnest money. This is essentially a good faith deposit that shows the seller that you're serious about buying their home. It's typically around 1% of the home's purchase price, but you get to decide how much earnest money you offer to the seller. The earnest money is typically due within 3 days of your offer being accepted. The good news, earnest money isn't an extra fee. It actually goes towards your down payment at closing. However, if you decide to back out of the contract for a reason not covered by your contingencies, you could lose this deposit. That's why inspections and financing contingencies are so important. They protect you and your money. So let's do a quick summary of the costs you can expect when buying your first home. The two main costs are your down payment and closing costs, and both of these aren't due until closing. Your down payment could be as little as 3% of the home price or 0% if you utilize a VA or USDA loan or a down payment assistance program. Your closing costs are typically between 2 and 4% of the home price, so we'd recommend budgeting an extra $5,000 or more for this. We can negotiate that the seller pay for your closing costs, but this may be unlikely if you're up against other offers. The two smaller costs that come up during the process are the cost of your home inspections and your earnest money deposit. After your offer is accepted, expect to make an earnest money deposit of about 1% of the home purchase price. And remember, this goes towards your down payment at closing. You'll definitely want to have inspections done, so budget $350 to $1,000 for this. Now let's talk about how one of the biggest mistakes first-time homebuyers make is waiting too long to buy, thinking they need a 20% down payment when they may be far better off using a 3% down payment loan. A lot of today's buyers may hear from their parents that they need to wait until they have at least a 20% down payment before buying their home. This advice is a little outdated, and while that sounds like a good idea, let's talk about why waiting and saving could actually cost you more in the long run. Here's some things to consider. So home prices are rising, similar to how Netflix keeps raising its price every 6 months. The longer you wait to buy a home, the more expensive it will get. With real estate in KC Metro historically appreciating 5% yearly, the $300,000 home today will likely cost close to $315,000 next year. But once you buy your home, you've now locked in that price and own an asset that is appreciating in value. As for Netflix, we don't know how to lock in that price. Sorry. Interest rates aren't expected to lower anytime soon. If you're waiting for interest rates to drop, you could be waiting years. And during those years, home prices will continue to rise. The final thing is rent is 100% 100% interest. Every month you wait, you're funding your landlord's investments, aka buying your landlord a new boat instead of building wealth for yourself. Buying now, even with a lower down payment, means that you can start building equity right away. Instead of watching home prices rise while you save up more money, you could already be in a home, gaining value, and letting your investment work for you.
So now that we've covered how much money you need to buy a home, the next big question is, will you actually get approved for a mortgage? This is something a lot of first-time homebuyers worry about, but the good news is it really comes down to two key things: your credit score and your debt-to-income ratio. Your credit score is a big factor when it comes to getting approved for a loan, and it also impacts your interest rate. The higher your score, the better loan terms you'll qualify for. But if your credit score isn't perfect, don't panic. Different loan types have different requirements, and you might have more options than you think. For conventional loans, the minimum credit score is 620, but higher scores will of course get better interest rates. For FHA loans, the minimum credit score is 580 or even 500, but you need a 10% down payment. For VA and USDA loans, there's no official credit minimum, but most lenders prefer 580 to 620 as a minimum. If your score isn't quite where it needs to be, don't worry, there are some easy ways to improve it before you buy. So if you're planning to buy a home soon, making even small changes to your credit habits can make a big difference in getting approved and securing a lower interest rate. Even if you meet the minimum credit score requirements, it's a good idea to actively work on your credit score before applying for a mortgage. A credit score in the 700s will get a much better rate than one in the 600s. So here are some quick credit building tips. Be sure to make all of your payments on time. Your payment history is the biggest factor in your credit score, so even one late payment can have a big impact. Next, keep your credit utilization low. This is the second biggest factor the credit bureaus look at. Your goal should be to use 30% or less of your total credit limit, and if you're able to use 10% or less, that looks even better. Lastly, don't close old accounts. Even if you completely pay off a credit card, it may be a good idea to keep the account open. Your credit age is part of your credit score, so keep old accounts open if possible. If you want to dive deeper into how to boost your credit, check out Graham Stephan's videos on YouTube. He has fantastic videos on how to improve your credit quickly. Even if you have a solid credit score, lenders will still look at your debt-to-income ratio, or DTI. This is how they determine how much house you can afford based on your existing debts. Your DTI is the percentage of your monthly income that goes toward debt payments, things like student loans, car payments, credit cards, and they'll include your future mortgage as well. The basic formula that lenders use for DTI is your monthly debt payments divided by your gross monthly income to get the ratio of how much monthly debt you have outgoing to how much money you have incoming every single month. Lenders typically want your debt-to-income ratio below 45%, but can go up to 55% for some loan programs. Let's look at an example. Lenders look at DTI on a monthly basis, as your mortgage will be a monthly payment. So if you and your spouse make $96,000 yearly, that's $8,000 each month. Assuming your lender will let your debts be 55% of your income, if you had no other current debts, they would allow your mortgage payment to be about $4,500 a month. They use this number to approve you for a certain home price. At today's interest rate, this couple would be approved for about a $525,000 home. Now let's say this couple does have some debt. Maybe their cars total about $600 a month and they have student loans of $400 a month. Their max outgoing debt is still going to be $4,400 in the lender's eyes. So $4,400 minus $600 in car payments and $400 in student loan payments leaves them about $3,400 for their monthly mortgage payment. At today's interest rates, this couple would be approved for about a $400,000 home. This should illustrate that the less debt you have, the more home you're going to be pre-approved for. So if your income is tight and you have a lot of outgoing debt, it might be a good idea to work on eliminating some of that debt before buying your first home. Lastly, don't feel like you have to run these numbers on your own. We're happy to talk with you about your unique scenario, so reach out to us if you'd like to run some numbers.
So now that we've talked about how much money you need and what it takes to get an approval for a mortgage, the next big question is, how long does it actually take to buy a home? Most first-time home buyers are surprised by this answer, but the process usually takes about 2 to 3 months from the time you start your search to the day you move in. Of course, that time frame depends on a few factors, so let's break it down. From start to finish, buying a home usually follows the same general steps. First, there's the home search, which can take anywhere from 1 week to a few months, depending on how quickly you find the right place. Some buyers walk into the first home they see and fall in love, while others need to look at many options before making a decision. Once you find the right home and your offer is accepted, you move into the contract phase. From that point, it usually takes about 30 days to close. During this time, your lender finalizes your loan, the home is inspected and appraised, and all the legal and financial details get sorted out. Finally, closing day is when everything becomes official. You sign the final paperwork, get the keys, and the house is yours. Here are a few key things that can impact how quickly you're able to buy. One of the biggest factors is how flexible you are in your home search. If you're open to different locations and features, you'll likely find a home faster. On the other hand, if you have a very specific list of must-haves, it may take longer to find the perfect fit. The time of year also plays a role. In spring and summer, there are usually more homes on the market, but that also means more competition, which can lead to sellers receiving multiple offers, and your offer may not be the best offer. In fall and winter, there tend to be fewer homes available, but there's also less competition, which can make it easier to negotiate and close on a home faster. If you're currently renting, your lease terms can also impact your timeline. That's why it's a good idea to check with your lease now before starting to look for a home. Now let's talk about what if you're renting. One of the most common mistakes first-time homebuyers make is not thinking of their lease until they're ready to move. Some landlords allow early lease termination or have month-to-month options after your lease ends, while others may charge a fee if you break your lease early. Another thing to keep in mind is that when you buy a home, your first mortgage payment doesn't happen right away. In most cases, you actually skip a month before your first payment is due, which can help with moving expenses and give you some financial breathing room during transition. For example, many landlords in the KC Metro will let you break your lease early with a 60-day notice. So let's say we're looking at homes and you find the perfect one and your offer gets accepted on March 1st. If you go ahead and give your landlord your 60-day notice, you'll likely be paying rent for March and April. Now, for the home you're buying, we'll have about 30 days until closing. So it's likely we'll close on April 1st. If you close in April, you won't make a mortgage payment in May, and your first mortgage payment won't actually be until June 1st. Because of how these timelines align, many first-time homebuyers find they have no overlapping bills and may actually have a month to breathe and save. The best way to begin your home buying journey is simple. Just give us a call. Whether you're ready to start house hunting or still have questions, we're here to guide you and make the process stress-free.
We'll answer any questions you have. Every buyer's situation is different, and we'll help you understand what makes the most sense for you. We'll connect you with trusted mortgage lenders. Having the right lender is just as important as finding the right home. We work with local professionals who offer great service, competitive rates, and a smooth loan process. We also always recommend getting quotes from multiple lenders. Even if you love the first lender you talk to, getting multiple quotes can help you find the best interest rate and loan terms, potentially saving you thousands over the life of your loan. It's also important that your lender is easy to reach, answers all of your questions, and provides great customer service. So speaking with multiple local lenders who actually answer their phones is key, and we've got great recommendations for lenders who do just that.
And even if you're not quite ready yet, that's okay. A lot of buyers think they have to wait until they have everything figured out before reaching out, but that's not the case. Even if you're a year or two out from buying your first home, we can help create a personalized plan to get you ready, whether that means improving your credit score, saving for closing costs, or finding down payment assistance options. So let's start the conversation. Buying a home is a big step, so don't figure it out all on your own. Your first home in Kansas City is waiting, and we'd love to help you get there.
What questions do you still have about buying your first home? Leave us a comment or, of course, reach out to us directly. And if you found this video helpful, don't forget to subscribe as we post videos every week about living in Kansas City.
We're Kat and Melanie of the Louis Higdon Group. And remember, there's no place like home here in Kansas City.